I think for me it's the latest trade tweets, really, because the 25% up from 10% went into effect on May 10th. And 90% of the S&P 500 had already reported results and guidance. So it hasn't been factored into the numbers. There might not be a huge impact, but if things do escalate, we get bad news out of the end of the month, the G20, it doesn't go as investors have expected, then you could see numbers come down, especially in the second half of the year, quite sharply.
Where are expectations right now?
Right now, for the full year, we're looking for 2.3%. I think Q2 is fine. We're looking for a decline of 1.3%. That'll probably be fine, but it's Q3 and Q4, 0.7% increase in Q3 and 8% almost in Q4. That's the real question.
We could be talking about another earnings recession. I mean, we talked about it last time. It didn't happen. But the numbers Lindsey's putting out there are negative to flat.
Wait to talk about it until we get a negative quarter, and then we can decide if it's going to be 2 negative quarters. Because I think flattish earnings is the story, right? Flattish earnings, how much the market's willing to pay for flattish earnings. It's all about, is it just going to be a lull, or is it going to be a rolling over of earnings that's going to last a while? That's what's going to matter for the markets, as opposed to whether we click negative for a quarter.
Barry, regardless of what is happening on trade, you're pretty relaxed about the domestic demand environment and think that can support GDP either way.
Yeah, no, I think that's one of the interesting things that's sort of slipped through the cracks over the last couple of weeks. To begin with, when you look at the various Fed regional manufacturing surveys, the capital spending plans 6 months forward held up remarkably well in May. They had been rebounding in April. It's a really good sign. Bottoms-up CapEx expectations still look pretty good. And then yesterday's NFIB, or today's actually, NFIB survey really confirmed that, both with capital spending plans and overall sentiment. Furthermore, the JOLTS survey showed a big pickup in turnover of the labor market. This is one of my biggest pet peeves for overall finance and how people look at markets is we had 75,000 jobs against 153 million job base. That's less than 5 basis points. Yet, if you take the quarterly turnover, the number of people getting a new job every quarter and leaving their job, that's 25% of that labor force. That turnover, and it's been picking back up again, it's a sign of dynamism, corporate confidence improving. That's a big driver of wage growth, but non-inflationary wage growth, actually productivity going up. So that improved as well. So I was overall, when I look at the story in the labor market, the story in business confidence, it looks like we're recovering from an inventory destocking cycle that was a consequence of the QT stock market crash, the plunge in retail sales that took place in December. That's recovering, and it looks like domestic demand is pretty good, notwithstanding this, business or trade policy uncertainty. So overall, that looks like a probably part of the reason why those earnings estimates don't get cut is companies or analysts just aren't getting that guidance from companies that things have gotten any worse.
Where are we